You know the old saying, what goes up must also come down? Well, how is it that currently everything seems to be going up at the same time? Signs of inflation like oil prices, labor prices, trade deficits, and yet markets are going up with stocks at all-time highs. Bond prices actually are rising as well. Government spending certainly seems to be going up and tax rates right along with it. So with all these things going up, what does it mean for investors? What should we be doing or thinking at this time? I'm Kent Kramer. I'm the Chief Investment Officer at Foster Group. And this is our regular financial perspectives where we take a look at what's happened in the last few weeks in investment markets and in the economy and try to determine what's important for investors to be paying attention to. The last 1 month, we've continued to have nice upward trend in stock markets. As you look at the U.S. stock market and U.S. small companies, both are up over 9% for the period. Foreign stocks are up over 5%. Really, it's been a pretty good month after a September where people were a little worried as to whether or not things were going to continue. If you look at the whole year of 2021, again, same story, really good year for stock markets around the world. U.S. stocks and U.S. small stocks up well over 20%. Foreign stocks up almost 9% for the year. There's a lot of places to be happy if you're a stock market investor. Things seem to be going up, continuing that trend that they started in 2020, which turned out to be a great year, even though it had a terrible start. So what are some of the results of all this upward momentum in the economy? Well, one of the things is these signs of the times. You can't go anywhere and not see help wanted signs. There are lots of companies, lots of businesses and industries who just can't seem to find enough workers to fill the positions that are available. Consumers are spending, businesses are spending, and it's hard for the labor market to keep up. Man, we see that borne out by recent jobless figures. The jobless rate fell to 4.6%, again, a record low since the pandemic began. The labor market added 531,000 new jobs in October alone. That was a nice positive surprise after a couple of months of negative surprises when things were slowing down due to the Delta variant. Even with that, if you look at the center chart here, you can see that the labor force has leveled off a little bit. Just like the unemployment rate or the number of people working, which went down and V'd right back up, the labor participation rate, the number of people in the job market, either working or looking for work, has kind of leveled off. And that leveling off has created what we see as this demand for workers and a difficulty in finding enough to fill the jobs that are available. So much so, depending on what industry you're in, you're beginning to see wage inflation. In other words, employers are beginning to pay more on an hourly rate. They're doing creative things like bonusing people for coming back to work in order to try to attract people back to their places of business. In some markets, look at the leisure and hospitality market, which is kind of the reddish line in this chart from the Wall Street Journal. You can see that wage inflation is well above 10% as employers continue to try to find people to come back to work. Hence all the help wanted signs that you see in the windows around your towns. Wages aren't the only things that are rising. The list of contributors to our current inflationary environment and the hand-wringing that seems to be accompanying it are well publicized. Food prices are up. Wheat was up between 40% and 100% over the last 2 years in terms of futures prices. Crude oil futures rose from $40 a barrel to $80 a barrel in 12 months. That's a 100% increase. Natural gas prices went from $2.60 to $5.60. That's just year to date, a doubling in natural gas prices. And the trade deficit set a record of $80.9 billion in the month of September alone. So you can see there's a lot of upward pressure on prices, again, because businesses and consumers are coming back into the market and spending. There's been a lot of pent-up demand, and it's been hard for the market, the supply side of that market, to keep up with the demand. We're really waiting for something or hoping that something called equilibrium appears again, and that's when supply and demand tend to even out. Right now, the demand is far outstripping the supply, whether it's for labor or certain goods. We see it in supply chain restrictions, people talking about having to order your Christmas gifts far in advance. What they're saying is, hey, we expect there to be supply problems through the holidays because the demand will remain very, very high. This has caused a lot of people, again, to talk about inflation in kind of a worried tone. And you can see from this chart why that is coming about. Inflation had been kind of trucking along there about 1.5% to 2.5%. But then recently, in recent observances, it went above 5% for the first time really since the 1990s. And that's got a lot of people's attention in terms of, well, is this a temporary increase to this level? Is inflation going to go higher? And if it does go higher, for how long will it endure at these new heights? The Federal Reserve is asking that question. Financial markets are asking that question. Investors of all kinds. Now, here's a way to look at it in terms of what the market expectations are for inflation longer term. This is the market for treasuries and tips, and this is called the break-even rate. And all it's doing is it's comparing the rate of interest being paid by a treasury inflation protected security and a nominal treasury bond of the same maturity. And it's saying the difference in those two rates being paid is the expectation of inflation over the next 10 years. So if a 10-year nominal treasury, if the interest rate is 2.5%, and a 10-year treasury inflation protected security, let's say its interest rate is 0%, that spread of 2.5%, the difference, that's what the market is expecting inflation to be, because the treasury inflation protected security is going to add whatever the rate of inflation is to the stated coupon rate. So if that stated coupon rate again was 0, but inflation turned out to be 2.5%, the holder of the tip would be paid 2.5%, the same rate as the holder of the nominal 10-year treasury would get 2.5%. The difference is the holder of the 10-year nominal treasury is always going to get 2.5%, regardless of what inflation does. The person who owns the treasury inflation protected security, if inflation is 2.5%, that's what's going to get added to that 0% coupon. If inflation is 5%, then 5% is going to be added to that stated interest rate. So you can see that treasury inflation protected security is kind of like an insurance contract against unexpected future inflation. Now, with any kind of insurance contract, you would expect to pay a premium. And with TIPS, or treasury inflation protected securities, that's the same thing. Generally, the stated rate on a treasury inflation protected security, a TIP, is somewhat lower than what the actual spread is going to turn out to be. And that lower yield is the cost of holding inflation protection. It's the premium. Think about other hedges that charge a premium. Life insurance, for example, it's a hedge against the loss of income should a wage earner die prematurely, and you pay a life insurance premium to own that contract. Same way for a disability insurance contract. You're hedging against the loss of income should you be unable to work, and you're willing to pay a premium now to hedge against that event in the future. And if that event were to occur, the contract pays off, and your investment in it was obviously a good investment because you hedged the risk. And instead of carrying that risk on your own, you pushed it, you transferred it to someone else. And if the risk were to happen, you'd be made whole. Now, what about kind of other markets and how they behave under inflation pressure? The question becomes, can I really hedge against inflation and still beat inflation over long periods of time? If we look at the performance of certain asset classes relative to inflation, we notice a couple things. In this chart, what you can see is the S&P 500 index, which is the dark blue line that tends to go up a lot at the end near the right. That shows a dramatic outperformance as compared to the rate of inflation, at least what we've observed over the last 24 years. That rate of inflation is the orange line near the bottom. So if you compare the return of the stock market, the growth in the value of an investment in the stock market versus the growth if you were just investing in something that increased at the rate of inflation, well, the stock market won big time. It generated something called a very, very positive real return, a return above the rate of inflation. If you look at the green and the bluish line, the ones that kind of move together, that is that 5-year, 0 to 5-year tip and 0 to 5-year nominal treasury. And what you can see is after you adjust for inflation, they tend to move together. Again, the expectation of inflation is built into the price of the tip. The nominal treasury is bought on the open market as well, and they tend to move about the same rate, and they tend to achieve a slightly higher rate than the rate of inflation, but less than 1% a year. So you don't get nearly the real rate of return in investing in short-term government bonds that you do with stocks. But you can see from the shape of the line, the stock market is a much riskier up and down investment relative to those treasury inflation protected securities or nominal treasuries. The green line there, the one that looks really choppy and ends up below inflation, that's actually the rate of return of a commodities index over the last 24 years. Sometimes people think of commodities or real assets like gold and oil, wheat futures, corn futures, things like that, that they would be a good hedge against inflation, because as the cost of goods rise in inflationary times, you would expect commodities baskets to rise as well. It turns out that commodities are related to inflation, but they're not very correlated in a short-term sense. In other words, when inflation is going up, it's not necessarily true that commodities will go up at the same time and by the same amount. The same thing when inflation levels off. And there's other things that drive commodities like supply and demand that cause it to be much more volatile than the rate of inflation. So in looking at this chart, what you can see is commodities don't represent a very good hedge if you're trying to eliminate the risk of inflation. And at least in the last 24 years, they haven't been a very good generator of real returns either. Again, just a little bit further decomposition of the stock market and other kinds of returns relative to inflation. In this study, which was done by Dimensional Fund Advisors, they looked at the real returns of different sectors of the stock market in years when inflation was high. So in years when you had above median rates of inflation, and the median rate since 1927 has been 5.5%. So in years when inflation was above 5.5%, what did these sectors of the stock market do? And what you can see is most all of the stock market sectors still provided positive real returns. In other words, they performed on average above the rate of inflation during the time period when that median inflation was 5.5%. The only asset class that really performed worse than inflation over that time period were treasury bills. Again, short-term instruments, fairly low interest rates. Sometimes inflation moves faster than those treasury bills, and so you get a negative real rate of return in certain periods of time. The other question that people ask about stock returns and inflation is, well, that's great if they outperform inflation over long periods of time, but what if inflation goes up? Won't stocks go down that very year, in the same year? In other words, is there a negative correlation between inflation and stock market returns? If we look at this chart from a similar study, also by Dimensional Fund Advisors, what you see are the red dots represent the observed inflation every year. The green bars represent the return of the stock market in that given year. In virtually every year, inflation is positive. In most years, the return of stock markets is also positive, some years negative. But what you don't see is that, hey, when inflation is high, stock markets go down. When inflation is low, stock markets go up. That relationship doesn't seem to be illustrated in the data. So the question then is, well, what should an investor do who wants to be inflation aware? Well, we think what the data shows is that for investors who want to be inflation aware, for that portion of your portfolio that needs to generate long-term real returns, rates of return higher than the rate of inflation, stocks are the way to go. For that part of your portfolio where you're trying to diversify against stock market risk, so you want some things to hold their value when stock markets are going down, government and high quality bonds tend to be the best diversifier. And those kinds of investments tend to keep up with inflation, even if they don't outperform them over long periods of time. And finally, for near-term spending and liquidity, cash and short treasuries tend to be the least volatile asset and provide investors with the most secure source of cash or whatever it is they need to pull on in order to meet current obligations. Short treasury inflation protected securities, short tips could also be part of this basket. And the reason we say that is if you have a need and you know you're going to need to fund something in the next 6 months and you're worried about unexpected inflation, if you buy a short-term treasury inflation protected security, a short-term tip, in 6 months, you know that the dollar you put in there today will adjust up for the rate of inflation almost no matter what happens. Because if inflation were, let's say, to go to 10% in 6 months, you would get a 10% adjustment in the yield on your tip because it's going to move automatically with inflation, whether it's expected or unexpected. The interesting thing here is that inflation-aware investing really equals sound long-term investing. There's nothing special necessarily about being inflation-aware and just being a good long-term investor. We say that investors should construct portfolios for their personal goals and circumstances. In other words, you should know when you need cash and make sure you have enough short-term reserves to fund that cash. You should have enough money in your portfolio to provide the long-term return higher than inflation so that you can meet your long-term goals like retirement. Investors need to always embrace uncertainty. We can't predict what inflation is going to do, so we want to fully diversify against the risk of inflation and other risks like markets going up and down. And then finally, we want to harness markets. What we've seen in these last charts is that markets tend to, at least stock markets, tend to dramatically outperform inflation for investors who are long-term thinkers. So we want to harness those markets by putting money into the stock market. We don't need to beat the stock market. We just need to harness it and make it work for us. If we were to add 2 more principles, you'd have all 5 of the Foster Group kind of core investment principles. We'd add advancing with science, making sure that you're listening to the best research out there. And we'd also say, hey, avoid predictable disappointments. There are things that we know lead to predictably disappointing results, things like using very, very high cost investments, for example, or trying to predict the future consistently. No one seems to be able to be successful in employing those 2 strategies over and over again. So inflation aware investing looks a lot like good long-term investing, and we think these investment principles can help investors become good and successful long-term investors. So that wraps up our financial perspectives for this week. As always, thanks for attending. If you have things you'd like us to address in future editions of Financial Perspectives, please forward those questions or comments to the contact information you see on your screen. And also, if you're interested in meeting with a Foster Group advisor, maybe you've got some questions about inflation or how different parts of your portfolio may be set up to operate in times of high or low inflation, please give us a call. We'd love to get together to talk about those concerns or any other financial planning and investment concerns or questions that you might have. Let us know. We'd be glad to get that meeting on the books. So again, thanks for attending, and we hope to see you in a couple weeks.